With the rise in the use of renewables as an energy source, nuclear is returning to the conversation. After Chernobyl and Fukushima, there was a marked drop in the adoption and use of nuclear. But in the current environment, it seems to be back on the agenda. But where does the world find the uranium needed? Well, John Ciampaglia is the chief executive of Sprott Asset Management, which works with HAN ETF on the Sprott Uranium Miners UCITS ETF. And he joins us now here in the studio. John, welcome. It's great.
Thank you for having me.
Look, this is an area that I'm a little unfamiliar with because I grew up knowing that nuclear wasn't the option. You talk to the next generation, all of a sudden it's becoming mainline conversation. Explain more about the context of where we are now and where we come from.
Yeah, sure. Well, absolutely. I think there was obviously a push away for political reasons mainly. After the accident in Fukushima in 2011. And in the last couple of years, we've seen a big swing in energy policy around the world, including the UK. And you must ask, what's driving this shift in policy, given it is a polarizing topic? And it's really about two things. It's energy transition, moving to more cleaner forms of energy production to reduce greenhouse gas emissions to meet net zero targets. And obviously in the last year or so, the world got a real shake-up and wake-up call in terms of what can happen to energy prices when security of supply is removed from the invasion of Ukraine by Russia.
Yeah, let's talk a little bit as well about the investment here with this ETF that I spoke about. What's your priority as the manager of Sprott Asset Management?
Yeah, so this ETF is really focused on the companies that are producing uranium, which is the fuel that we need that goes inside of a nuclear reactor. The fuel is basically a critical mineral. It can't be substituted with something else. And just for some context, uranium, it goes into nuclear reactors, produces about 20% of the world's electricity. So it's a pretty important form of energy production. Some countries obviously have much higher use of nuclear, such as France. The UK is fairly high as well, parts of Canada and the US. And the reality is, after those accidents that we had in the past, a lot of the mining production basically was turned off because prices collapsed of the mineral. And now that the world is looking at uranium and nuclear energy again, we need to produce a lot more in order to build all these power plants of the future, which are mainly happening in places like China and India and even the UK.
Yeah, that 20% number is interesting. Is there a drive, do you think, to push that up? Or should the world be satisfied that 20% is okay, bearing in mind we've got other renewable sources coming online, which has to be said are less reliable?
Yeah, and that's one of the big acknowledgements that's come out in the last couple of years, is that as the world has built more renewable energy, which has been obviously very positive in terms of solar and wind and hydroelectric, the big issue there is intermittency. And as the UK, I know, recently experienced what they call a wind drought, where it doesn't, the wind's not blowing for 2 weeks, and then your power generation falls. So the world has really three options in terms of backing up intermittency of renewable energy. You can either burn coal, which we're trying to do less of. You can burn gas, which we're trying to do less of and move away from Russian supplies. Or the third option is have a nuclear power plant. Those are the three options. And obviously governments are acknowledging that they need to have reliable, affordable baseload power to back up renewable energy, which is intermittent.
This would seem to create opportunities for uranium miners. Just explain the balance between demand and supply, first of all, because if the world is moving more into this area, one would suggest perhaps maybe there might be some sort of deficit arising. What is the situation about the supply-demand balance between where we are at the moment in the uranium?
And that's why most investors are intrigued by this investment opportunity, because the world needs about 180 million pounds of uranium every year. And right now the world produces about 135 million. And so you might wonder, well, how does the industry function if it's got a supply deficit? Well, it's basically relied on secondary supplies and legacy inventories. But with all the new reactors being built in places like India and China, that 180 million pounds per year of demand, we think, is going to be going up to 250 million. That means we need to build a whole bunch more new mines, and that's really the investment opportunity.
In the ETF, is there a uranium element to this? Do you follow them? Because I think the ETF is mainly companies, isn't it?
Correct, yeah. So what the ETF does is gives you broad exposure to the investment universe, which is the largest producing companies of uranium, things like Cameco from Canada, Kazatomprom, which is one of the largest producers in the world. It provides you some exposure to the companies developing the mines of tomorrow, companies exploring for new mines, we call them exploration stage companies. And then finally, you get some exposure to physical uranium itself through the Sprott Physical Uranium Trust, as well as Yellowcake PLC. So you get a little bit of, everything all in one ETF.
Let's bring up a chart because we've spoken a lot about the ETF itself. Look, we know the markets have had a torrid time since the start of this year. On the right-hand side here, this most recent rise was, I think, the highest we've seen was at February. Since then, of course, obviously, the world has changed, I think, in the investment environment, to put it mildly. What is this responding to? Let's take things in order. First of all, interest rate rises we've had. How does the market, for what we're talking about here, respond to higher interest rates? Is it insulated from the macroeconomic, do you think?
No, it is not. Unfortunately, even though the fundamentals of the uranium market are incredibly bullish, it has not been able to shake off a lot of the noise and the headwinds from a macro perspective. In the last, I would say, 12 months, since the Federal Reserve in the US and other central banks have been raising interest rates, it's definitely held back this sector. It is a volatile sector to begin with. These are many smaller, earlier stage companies. They're not very large. And so they tend to be a little bit more vulnerable to these kind of risk on and risk off kind of moments in the market. And obviously in the last couple of months, we've seen a lot of people sitting on the sidelines as expectations around inflation have not gone away. And more recently, some of the banking issues that we've experienced.
And of course, coincided with this period, we've had the war, let's call it a war, going on in Ukraine. Again, to what degree has this sector been affected by that?
It's actually been affected quite a bit. And the reason for that is because Russia is actually a pretty meaningful player in part of the nuclear fuel cycle. So Russia doesn't produce a lot of uranium, about 15%, but they're very instrumental in how uranium gets refined and ultimately turned into fuel that goes into a reactor. And what we have found is that over the years, we've outsourced these services to Russia as a low-cost provider. And now the West wants to basically reshore these services, and we don't have the capacity. And that is creating a bit of a challenge for the market. So we definitely believe that uranium prices will benefit from this over time as the world moves away from Russia.
Yeah, and let's talk most recently about the market disruptions. It's mainly centered around the banking sector, of course. But again, same question, is there a contagion effect within this sector? Again, going back to this idea about the fact we're talking here about a completely different area, renewables, which is tick box. We've got a deficit, which is tick box. We've got opportunities here for the future. Why is the UCITS ETF and the US ETF down on this most recent news about the banking sector? Or is it just contagion generally?
It is. I think generally there's a lot of uncertainty. People want to know, is there another domino to fall? And what we find in these periods of uncertainty, that investors just go to the sidelines. They just don't want to put their capital to work if they might be surprised by another event. It does feel a little bit like 2008, 2009 all over again. I would point to the trillions of dollars that are sitting in money market funds around the world. People are just kind of sitting on the sidelines right now.
Yeah. Okay, let's just wrap it up and take your view from where we go from here. We're just about to go into the second quarter of the year, of course, as we speak. How's the rest of the year looking? Let's assume there's no more big downside to come in terms of the market moves. It looks like we're peaking on interest rates. How do you view, as the fund manager of this ETF, how do you view the rest of the year?
Well, I think once we get through this anxiety and I think uncertainty with respect to inflation, the banking system stability and whatnot, I think commodities in general are very well positioned. And I say that because many of them are in chronic undersupply. We've underinvested in many of these sectors for the last 10 years or so. And the world's kind of figuring out finally that we need a whole bunch more commodities to do all the things we want to do. And I think that provides a very interesting long-term secular growth story.
Yeah. Look, John, it's a pleasure. Thanks indeed for your time. It's great to be able to catch up with us. John Ciampaglia, the Chief Executive of Sprott Asset Management, which works with Han ETF on the Sprott Uranium Miners UCITS ETF, which is the ticker symbol URNM.